Oh, that's smart.
All right. What's smart?
That's very smart. You put the.
You hear me okay?
I can. You put the hat on,
brilliant.
and you don't have to worry about the lockdown hair.
No, it's crazy.
Oh, your hair looks all right. Wait, you've been to the bloody barber.
Yeah, I have, just before the lockdown.
Oh, of course, you haven't been locked down for 8 weeks.
No, we're just following your path. Can you hear me okay?
I can hear you perfectly well.
Yeah, brilliant. Okay, good. We'll just get the audio. Yeah, good.
How's that sound?
Yep, you're coming through loud and clear as well.
Excellent.
Okay. Hello and welcome everyone. I'm Robert Baharian and this is Masters in Investing. On this show, I talk to guests about financial markets, the economy, investing and business. Don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today is Tim Farrelly, principal of Farrelly's investment strategy. During our conversation today, we spent a bit of time talking about inflation both here in Australia and around the world. We then talk about interest rates and also, more importantly, what that then means for the stock market valuations, and for investors. We also spend quite a bit of time talking about what it means for banks, what that then means for lending, borrowers, residential property prices, and residential property investors. Had a really good conversation with Tim today. Hope you enjoy the conversation. Tim Farrelly, welcome back to Masters in Investing.
Hi, Rob. Looking forward to it. I think we've got a lot to cover today.
Yeah, I think we do. And I think a lot has happened since we've last spoken. Probably the biggest thing I think that is on investors' minds and that is being talked about is inflation, not only here in Australia, but also around the world. And who would have thought, I mean, this was something that no one predicted. The bond market didn't predict it. And in fact, the bond market still doesn't predict it. And you've got big inflation numbers really spiking. People are talking about the fact that this is transitory, it's not permanent. I'm really curious, like, what are you thinking about, Tim, at the moment as it relates to inflation? Is it permanent? Is it transitory? Because a lot of the numbers that are coming out right now is things like things that have bottlenecks in their logistics system, for example, cars or a whole bunch of other things that I can't think of off the top of my head right now. And would it not be safe to say that if and when you'd like to think things start to become a little bit more normal, that these bottlenecks are freed up and these inflationary pressures we're seeing at the moment are in fact transitory? Yeah. How do you see it from where you sit?
Can I take a step back? And I think it's useful to do this. To say, why are we even talking about inflation? Why do investors talk about inflation a lot? And I think the answers are reasonably straightforward, because typically you've got a central bank whose job it is to keep employment fairly full and inflation moderate. And that's pretty much all their job is. And they've pretty much they have one and a half tools, but their main tool is just short-term interest rates. It's like, it's funny, from a central bank perspective, it is one of the simplest jobs in the world. You've got two things to worry about.
To manage the inflation?
Manage inflation and employment, and you have one tool. It's like, it is, compared to your job, it is dramatically simple. I'm not saying it's easy, but it's a simple job. But basically, the story is this, is if they feel inflation is getting out of control, their one tool is interest rates, and they will lift them up until such a time as the economy slows enough to take the inflationary pressures out, or if the pressures are big enough to put the economy into a recession, which ultimately has proven in the past to kill inflation. So that's kind of the setup. Now, anytime you get a slowdown, that's bad for company profits. A recession is really bad for company profits, and rising interest rates puts valuations under pressure. So if we're prepared to pay 20 times earnings, when interest rates are zero, we might only be prepared to pay 18 times. And so both of these tend to reduce the price of equities. And similarly with property and both asset classes. Even when we get to bonds, and we'll talk more about bonds later on, if the market's convinced that interest rates are going to be higher for a period of time, then bond rates go up, and that also causes bond prices to fall. So that's kind of the backdrop about why is it we're worried about inflation. I guess then bringing it forward a little bit, if you're an investor worrying about inflation, you've got to ask yourself a couple of questions. And the biggest question is, what is my time horizon? If you're a typical person, an analyst working with a stockbroking firm and the chief economist there, or if you're making short-term asset allocation decisions, as a lot of funds like to make, financial planners like to make, the next couple of years are really challenging and interesting for you, because either the Fed in particular will finesse this beautifully and will just increase interest rates enough just to keep things down. And yes, we see some transitory inflation and it doesn't kick on, and it all just gets managed beautifully, great for the equity markets. On the other hand, this is the great fear for many commentators, is they're too soft, they let things go, and all of a sudden we've got 4, 5, 6% inflation, and it's kicking in, and they have to get heavy-handed, and now they cause a recession. So if that's your time horizon, which is sort of next 2 to 3 years, and you're having to make decisions around that time horizon because that's your job, this is really, really tough. You're effectively saying, do I think the Fed is going to be able to finesse this or not? And the almost binary outcomes. If they get it right, fantastic. If they don't, big trouble. So it becomes a big bet.
But you're Tim, having to constantly make that bet, right? Like, even if you get this right or wrong, you've then got another decision to make. And it's this constant, never-ending battle. And I feel like it's a really low-quality decision to try and make when the probabilities are completely stacked against you. Who's to say that you even got the call right to begin with? Because quite frankly, the bond market to this day, 10-year treasuries and the 10-year Australian government bond is still reflecting a low inflationary environment, notwithstanding the current interest rates, inflation spike.
Yeah.
And so I guess the question is, are we saying the bond market's wrong?
Oh, well, let's come to that in a minute. But back to the point you've just made, which I think is a brilliant one, and I think everybody should really think about this deeply, is there is such a huge number of people, really smart, well-informed, well-resourced investors trying to make decisions over this 1, 2, 3 year time horizon. The chances of even them winning are really remote. For less informed people, so you're not working for Goldman Sachs, you don't have a former member of the Fed working in your team, like what chance do you have? I was thinking of an analogy. I went to a pretty tough school. Some of the guys in my school were pretty handy with their fists. I mean, they were way above average. You put them in a ring with a professional boxer, most of them wouldn't last 30 seconds. They are good. They were really good. And that's in the schoolyard, very handy with their fists. And then you say, well, what about amongst the professional boxers? Well, amongst the professional boxers, if you're not world champion, it means you're getting a beating. There is literally in every weight class 1 or 2 or maybe 3 people who are undefeated. Everyone else is getting a beating. Investment's so much like that. It's not just, I'm an above average investor, I'll make money. No. You've got to be right up near the very, very top in order to have any sort of confidence about making money. And so to basically get in this, I'm going to make the 1, 2, 3 year decisions. I kind of think it's like getting into the ring with a pro boxer. Even though I was pretty good in the schoolyard, pretty handy with my fists, I'm going to get slaughtered. And I think it's a really useful analogy. And it sort of gets back to this point of, well, if I'm worried about inflation from a 3-year perspective, and I'm trying to outguess the people at Goldman's and Macquarie and all the proprietary traders around, I've got a pretty high level of confidence I'm not going to get that one right. On the other hand, if you go to another place where they don't tend to play, which is the 8, 9, 10 years, because their clients don't want it. It's like, no, we want the short-term decisions. All of a sudden, life gets a lot easier. I am very confident that over a 5 or 6 year time horizon, that regardless of which one of those routes we go down, the Fed, the RBA, wherever, will stomp on inflation. Now, whether they do it gently or whether they need to cause a recession to get there, but I think we get back to inflation running around 2%. So if I'm making a decision with a 5, 6, 7 year time horizon, I think we can be reasonably confident where inflation is going to be down that track. And it's going to be around 2 or so percent, unless the central banks basically abandon their mandates. And I don't see any sign of that. They basically have this mandate, keep inflation low. They have one tool. If inflation starts picking up for any length of time, they almost have no choice. They've just got to pull the lever. And so I don't worry about inflation so much in the long term. But one of the useful kind of questions is, if you were genuinely worried, and look, there's some good papers I've been reading recently saying there are moves afoot to say that we could get some inflation coming back over the longer period, and it's going to be much harder than usual to get out of the system. If that's where we're going, you've got to then start worrying, well, what do you do from a longer term perspective on that portfolio? Right now, I'm kind of comfortable that I think central banks will step on it, but that may not be the case.
And if you do have inflation running away, I mean, presumably central banks and authorities are not simply looking at headline numbers. I mean, there's smart enough people that are looking through all the headlines and saying, well, what is it? What's driving it? Is it wages? Because I think wages, and tell me if I'm wrong, is one of the things that if you want sustainability, you got to have people's wages rising. And you got to have people's wages to support these higher prices. You can have higher prices.
Historically, there's been 3 things that really have driven sustained bursts of inflation.
Yeah.
The ones that kind of hit that people talk about, Zimbabwe and the Weimar Republic in Germany, are ones where typically you've had too much money chasing too few goods. And both of those cases, a lot has been made of the money printing, and that certainly went on. But also, from the accounts that I've read, I wasn't there. If you went into the shops, there wasn't anything there. The whole economy had broken down, and there just wasn't enough goods. And the government was pumping money in the system, so the prices just ran away. Now, we are a million miles away from that sort of situation. But in some narrow pockets, we're seeing a bit of that. Like, famously, used cars prices are going up because there's not a lot of used cars around, because there's not a lot of new cars coming in, so people are holding on to their old cars. And so used cars prices are going. But that's a shortage of goods. Now, that is definitely transitory. So the next one you worry about is too much money. And there is an element of that here where governments are running big budget deficits. Now, to me, quantitative easing, not inflationary. I think we talked about it another time, and I won't go into that now, but running big budget deficits is inflationary. In my mind, there's no question about that. The question is, how inflationary is it? So, for example, let's say we run a budget deficit this year of 6% of GDP. Now, in a typical developed economy, the value of everything, and that's people's land, their properties, all their own thing, everything they own, runs at about 600% of GDP. So if the government gives away, effectively, which is running a deficit, 6% of GDP, it basically says if everybody thinks they're now worth 606% of GDP, when they're really, but we don't have any more stuff. And that basically says 6% of GDP equals 1% of inflation on a one-off basis. If we've got a 20% deficit, it basically says it's about 3% inflation one-off. And so the issue around that is, yes, that is inflationary, but it's really not going to, they're not going to keep doing that. Well, it's unlikely. And so, and also in the environment we've been in, which was an economic shock, we probably would have had a bit of deflation without that stimulus. So it's, you add 3% to the -2 and you end up with the one we observed. And maybe it's a little bit more than that. So we have got this little bit of pressure at the moment. For that to actually not be transitory, it really has to, as you indicated, has to get into the wages system. In the 70s, which is the most recent big episode we've had in developed countries, the basic mechanism was pretty clear. We had the oil shocks, which put up the price of everything. Now, oil and energy was a much bigger part of the economy then. People were not nearly as efficient in the way they used energy. So when prices went up, it had a big impact on the cost base. That was passed on to goods. So the goods went up and we had a burst of inflation. Unions were very strong at that point. The economy hadn't really globalized to anywhere near the same extent. And so you couldn't just say, well, if American workers are putting up their prices, we'll just go and build it over there. That wasn't happening. And so what happened in that environment, unions are strong. We've had 6% inflation. They want a 6 or 7% pay rise. And next year, the companies have all had 6 or 7% added to their cost base. So they have to put their prices up, which means inflation works out 6. And it's the wage price spiral we've all heard about.
Sure.
And essentially, there, in order to stop that, you need to take away workers' bargaining power. Now, to some extent, they don't have anywhere near the bargaining power they used to have, particularly through the union movements, which aren't nearly as strong. And, you know, we saw what it took to break that. Was Paul Volcker, and then a lot of central banks around the world took interest rates to 19, 20, 21, 22%. It didn't just slow the economy, it absolutely killed it stone dead. Major recession. And now when you turned up to work and said, look, I need a pay rise, it's like, well, what we'll do is you can keep your job. And, you know, in Australia, there was the accord where if you don't increase your pay much, we'll give you a small increase, and then it all flowed through into lower prices or lower inflation, and it got stamped out of the system. So the question is, you know, what is the chance of that breaking out again? At the moment, I would say it's pretty low. There are some people that argue, and, you know, quite sensibly, or they're logical arguments, that the way that demographics are rolling over, there are going to be less workers in the economy, but still with more and more retired people, more people consuming. So there will become an effective shortage of workers, and employers are just going to have to bid up the prices to get access to workers. So it's not about unions, it's about we need to get more access. Another way of describing the same impact, or it's an outcome, is for years, salaries as a share of the economy, both in Australia and the United States, have been falling and falling, and profits have been going up. It's, you know, the whole inequality piece. If government can engineer policies, or if the world just works out that way, where all of a sudden employees start picking up their share of GDP and it gets back to something like the levels we were before, we're going to see wages going up faster than prices, which then it kicks in, and you can get something of a spiral going. It doesn't have to be anywhere near as bad as the 70s, but it's certainly not out of the question in that type of scenario. We might get to 4 to 5% inflation, and it may even be at that stage the Fed, having caused one recession, and then it bounces straight back again when they take the foot off the brake, realise that actually higher wages are a response to years of inequality, and is actually a way to go. And part of the price you pay for that is going to be a little bit higher inflation. So we might get wages growth at 6 and inflation running at 4. So there's,
you talk about, Tim, the 70s. We'd crunched some numbers, and from 1970 to 79, so through that 1970s decade, the average inflation rate was running at 7.25%.
Yeah.
And you had subsequent, I mean, this is US data because we can get good quality data going further back. The US stock market return over that time was down about 47% during that time.
Yeah.
And then since then, really, we haven't seen anything. right to the 80s, 90s, the 2000s, we had people try and correlate inflation and stock market returns. During the 2000s, inflation was running at 2.5%. The average stock market return was down 15% for that decade. So it wasn't inflation that was causing it. And it's really difficult to try and find some correlation between purely inflation and stock returns. I mean, it then kind of gets me thinking, I've read a number of pieces, a number of notes that have talked about the best way to hedge against inflation. You got to buy gold and you got to buy Bitcoin and all these things. And the way I really simply think about it in my own mind, you gave these examples about businesses, their costs are rising, their expenses are rising, which then in turn they raise their prices. Aren't businesses the perfect asset to own during an inflation period? Because they're the ones that can pass on the prices, right? Like, how else do you hedge it?
You would think so. Turns out the answer is no. And the answer is no for this reason. Let's say we were going through this period that it's not my base case, but I accept that there's a possibility. And during this period, we're getting 6% wage rises and 4% inflation. So in that environment, and the Fed have got, and interest rates are kind of running at about 3 or 4 or something like that. In that environment, what you're going to find is a number of things. Firstly, if wages are going up 6 and prices are only going up 4, margins are falling. And so that's bad for businesses. So they might have sales growth going up in line with the economy, which is normally what it does, which in this environment, 6 plus 4 is a 10% sales growth. But their costs are going up even faster. They're going up at 12.
Right.
They might find their profits, instead of growing at, they'd expect to grow up at 10, not in real terms, but in absolute terms, they might only grow at 8, say. And in real terms, they're only growing 2. So in real terms, their profits aren't growing much. That has a minor effect, because that typically is the way it works. The businesses, well, certainly in the 70s, had real trouble passing on the full price increase, the full impact of their wage increases. Wages were going up faster than they could put up their prices, squeezing their margins.
Yeah, I hear you.
The second piece, which is much, much more important, is today we're prepared to pay, call it 20 times for $1 of earnings, price earnings ratio of 20. If cash rates were 4 and bond rates were 5 or 6, we're not paying 20 times. It's more like 14 or 15 times.
Sure.
So you've now whacked 25% off. So basically you're in a situation where, let's talk about the US market. You've had earnings growing at, I don't know, call it 4 or 5% a year. But P ratios being whacked right down. You've had 1 or 2% growth, and your dividend yields at the moment 1. You might get a 3% total return, or 2, or could even be less. And so that's the environment we're in. And if we've got a 2 or 3% total return, inflation's running at 4, you're going not out the door massively backwards, but you're going out backwards. And that initial adjustment period is the really bad one. It's when the market first decides that, okay, 20 is not the right price anymore for $1 of earnings. It's more like 15. What you then happen, you've got a bear market. Then the bear markets invariably overshoot, and 15 goes down to 10 and 12, and all of a sudden you're down 40%. So in the inflationary environment, you've had a bear market. So you translate, so, well, what else could we invest in? That's a good inflation hedge. And the one you often hear about is property, because rents go up with inflation, and they do. But a similar kind of thing applies. We have seen over the last few years, let's talk about office. In the office space, 8 or 9 years ago, yields was kind of like 7%. And now they're about 4%. And the compression's still happening. And so you kind of say, well, why were yields 7? Because interest rates were at 5. And now interest rates at 1. So now we go through a period and say, let's say we're back to 4% interest rate, 6% bonds. Yields are back to 7% again, maybe 8. And so that means I've bought a property with a 4% yield. If it starts trading at 8% yield overnight, doesn't happen that way, but if it was, it's just fallen value by 50%.
Yeah.
So how long does it take to get that back to my 3 to 4% per annum rental growth? A long time. And so over periods of, let's call them 6 or 7 years, you can own these assets, and if we get inflation, you are going to get whacked. Then you say, oh, well, why don't we buy inflation-linked bonds? Now, inflation-linked bonds, as you know, they pay yield, they pay inflation, CPI, whatever it is, plus a yield, but except the plus is now a minus. It's about minus 1%. So you're guaranteed, no matter what inflation is, you're going to make inflation minus 1. Okay, well, that one doesn't work for you. We've bought bonds. We buy 10-year bonds at a yield of, call it 1.2 at the moment. Inflation's running at 4. Okay, that one doesn't work. Residential property, that's going to be fine. Can you imagine what will happen to residential property in this country if the average loan has got a mortgage rate attached to it of 6-7%?
Overnight?
Or over the next year or two. It's like, it's going to get slaughtered. Property prices down 40-50%. So that's not going to do it for you. And as you just look through asset infrastructure, people argue the infrastructure.
You think a 40 to 50% decline? Presumably you're talking about presumably you're talking about a median valuation though.
Yeah, median. Some will go more, some will go less.
Sure.
And now, part of this is why I don't think interest rates are going to go as far as they are, because I think at interest rates,
because all the outcomes are just really shitty outcomes. Is that why?
It's kind of like a cash rates at 3 and 4, even with a bit of inflation out there. A large swathe of domestic Australia is in a domestic recession. The average household, or any household with any sort of decent loan, and it's a lot of them, have basically had all their income taken away. You know, we've got the loan to household income ratios are higher than they've ever been. So a 1% increase in interest rates has a much bigger effect today than it used to have in the past. A 3%, you know, it's... I remember when I took out my first significant home loan, which was back in I think it was 1989 or so, and I took it out when cash rates were about 11, and they quickly went to 21. I was paying 22% on my mortgage. You know, we literally had almost no income in the house. It was really desperate. You know, discretionary spending, forget it. We weren't spending on anything other than paying off that mortgage. And so today, with the much larger size of mortgages, I think a 3% increase in interest rates could have a similar effect. So basically what I'm saying, 3% interest rates, we have a recession on our hands. And in that recession, you know, wages aren't going up. And so that sort of tends to kill it. Now, whether it keeps bobbing back, you know, in that other scenario that I described, it's possible. But that would be a really nasty economy. We'd be zigzagging in and out of recession, in and out of recession. The bottom line is this domestic Australia, the Australian public, forget businesses, Australian public cannot afford 4 or 5 and 6% cash rates. They've got too much in floating rate debt. It's a little bit different in the States. Most people in the States buy 30-year mortgages, fixed rate. Rates go up, no problem. So in the States, the Fed's job is very different from the Australian RBA's job, because they're having to try and influence the activity through the business sector, whereas in Australia it's the household sector, because we've got the floating rate loans, which makes the RBA's job easier.
Is there an argument, Tim, to say that central banks, whether it's in Australia or in the US, allow a bit more leniency on the rate of inflation given the amount of debt that they have? And, you know, it's somewhat of maybe a bit of a conspiracy theory, but then you can start to chew away at your debt, right, without increasing interest rates, and the real value of those loans start to diminish.
The critical thing in that dynamic is not so much inflation, it's what the real interest rate you're charging. Because, for example, if you're having, currently the RBA is paying 0 on its borrowings, and inflation's kind of running at 1.5, maybe 2. So if inflation went to 4, if they're still paying 0 now, their debt's being wiped out at 4% a year. But if interest rates went to 6, that's actually a huge swag out of the budget. And now their budget deficit's blown out. They have to borrow more money. Actually, at 6% interest rate with inflation of 4, our debt position is worse than it was at inflation at 1.5 and interest rates at 0. So it's the real interest rate you've got to concentrate on. And absolutely, their interests are aligned as an arm of government with keeping real interest rates very low.
Yeah.
And so I think that's a better way to think about it than rather inflation. And given their mandate is really clear, they've got to keep inflation low. They are much better off keeping inflation kind of around 1.5, 2.5, and interest rates below that, rather than letting inflation get away and then kind of wondering what to do. So I think
the fact that we're talking about this now, we're talking about potentially the lack of substance to keep inflation where it is now. The bond market's saying it's baloney. We don't think it's sustainable. You've got bond rates, 10-year bond rates again heading south again, and then you talk about having vested interest in making sure that the economy itself doesn't blow up, and kind of the government then has egg on their face. There are a number of other ways to control spiraling, I shouldn't say spiraling, record prices that are running away, whether it's in the residential property market, through other measures than simply trying to use interest rates.
Oh, absolutely.
And so I think they're two very different things, right? Like inflation and interest rates and risky asset prices being driven higher and higher and higher. I don't know how much control that they have then on risky assets to the extent that we talk about stocks, but certainly as it relates to property, residential property, which is the biggest asset here in Australia for Australians, that kind of has its own little toolbox in the shed,
absolutely.
Right?
And the distinction you make is so important. I got to say, one of my massive frustrations is when I hear people, I call them accountants, and said, 5 years ago, you were talking about runaway inflation. It hasn't happened. They said, we've had asset price inflation. And I go, hang on. The reason we as investors worry about inflation is because it makes asset prices go down. So implicitly what you were saying 5 years ago was asset prices were going down. And now you're saying, I was right, asset prices went up. And I'm going, I'm calling you on that one. That is nonsense. It's the reason we like inflation to go down is because it makes asset prices go up. So this idea is going to show up, but like it's just, I think it's a get out for people making bad calls. So, but back to that one, and it's a really good point, right? Because everyone's interested in residential property prices, and I've done a lot of work on this, and I'm absolutely convinced it's right. And it's been through a few regime changes, and it's worked every time. And it basically goes like this: the thing that sets residential property prices, I think, is how much the bank will give you when you turn up saying, I need a loan.
100%.
And
they've already done the homework. They've already done the calculations based on your situation, more or less.
Yeah.
And you're right. People will push, if not push more, beyond what the banks will give them. Because every single time.
Here's the way I describe it. Young couple, you go out looking for a home. Your first day, you've been out, you've seen 20 homes, you've come back, you're utterly depressed because you cannot believe how little you get for your money. You're crushed. The places you were thinking you were going to go, you're miles away from it. So what do? You basically go, right, we'll go in the bank on Monday. We're going to work out the absolute maximum we can borrow, and that's what we're going to spend. And so when the banks change their lending standards, everybody in the market, if they're saying we'll give you 10% more money than we were going to give you before, everyone in the market gets 10% more money. Guess what happened to prices? They go up by 10%. And I've tracked this one.
It's like when the government provides duties or grants, it's more money tipping into the pot and fueling the fire.
They're not making more houses. The price just goes up. It just has to. And so it's not the amount of money in the system, it's the amount of money banks will give you when you turn up. And now the way the banks calculate that Well, let's go back to the way they used to calculate it. Back in the old days, they would say, okay, we're going to work out, based on your income, how much we think you can use to service your debt. If the interest rate is, I'm going to use 8%. If the interest rate is 8%, they say, well, interest rates might go up a bit, so we'll add 2 onto that. So we're going to assess you at 10. And let's say they thought you had $50,000 a year in excess spare income. They would say, we will give you $500,000 because 10% of $500,000 is your $50,000, and away you go. You roll the clock a bit forward, interest rates have fallen down to 3%. They add on the 2 and they go, okay, well, now we're going to assess you at 5. And at 5%, 50 grand, we can now give you $1 million. And that happens to everybody in the market. So X years ago, you had 500,000, now you got $1 million. Guess what happens? Housing prices double. So I've tracked median weekly earnings or annual earnings divided by bank interest rates. And guess what? Housing prices track them really closely. And the 2 really good tests for that have been, I think it was back in 2015. APRA finally, I think a stroke of genius. Genius is probably the wrong word, and we'll see why in a moment. But they came out and said, enough. It doesn't matter how low interest rates go, the banks can't assess you at less than 7.25%. So even if interest rates were at 1, they can't just add 2 and say, oh, you're going to assess you at 3, it's going to be 7.25. The moment they put that in, and they put in another, APRA put in another range of measures to say, well, you need to check up their expenditure and a whole bunch of other things that effectively meant you couldn't get as much money as you got before. Guess what happened? We went through about, you remember it well, 2 or 3 years, but prices came off about 10%. And so banks tighten lending standards, prices fall. Then immediately post the pandemic crisis, APRA panicked and said, the 7.25 is gone, banks do whatever you like. And, we've had the discussion at the time of saying, this means that when you turn up to the bank, they're going to give you a lot more money than they would have given you 6 months ago. A lot more money. And this is going to drive prices through the roof. Guess what's happened? So it's been really useful, I find. You have theories and they seem to work. But when you get regime changes, like they put the 7.25 in, then took it off, it's really clear what should happen. And when it actually does happen, it says, okay, this theory not only sounds good, but it actually works. And so you take that now and say, well, back to your original point, do they have other tools? Absolutely. When it comes to house price inflation, APRA, and apparently they're toying with it, will put back another equivalent of the 7.25. It'll probably be 5.25 or something like that. But, APRA, I said before, it sounded like a stroke of genius. I think it was. Because one of the difficulties from a Reserve Bank perspective is they don't want to think about housing prices as part of their decision set. It's full employment they're worried about. And so when they cut interest rates, if housing prices can't take off, it's like, oh, we really wish that didn't happen. But that's not our responsibility. So when APRA stepped in and said 7.25 is the minimum, the RBA could do anything they like with interest rates, taking them down at least, without impacting housing prices. Now, the reason it's important for them, the APRA, to do that was if they're tracking, if lending standards and housing prices are tracking interest rates, when they go up again, all of a sudden you've got a crisis. Banks are tightening lending standards, which will make housing prices fall. And now banks have got this situation where they've got a huge asset on their books, being loans to houses, where the value of the security is diminishing. So it's creating instability. So, for APRA to panic and lift that one, I think was monumentally stupid. I suspect it was government policy. I suspect they were instructed by the Treasury or the Treasurer, more to the point, to do that. And they did it, and we've had the predictable effect, which is, for Australia socially, I think a disaster. The last
can I just add something to that, Tim? Just bring this up. So looking at core logic data, and I crunched the numbers on this. So you go back to the mid-90s, 1996. I rebased every capital, well, the five major capital cities in Australia: Perth, Sydney, Adelaide, Melbourne, Brisbane. Melbourne's been the best performing since then. And Melbourne has grown 435% over the time. Sydney, 368%. Adelaide, 264%. Brisbane, 241%. Perth, 178%. Let's annualize the figures. Melbourne, from 435%, it's risen 6.94%. Sydney, 6.37%. Adelaide, 5.3%. You get my drift.
Yeah.
And then we strip out inflation and an inflation-adjusted real return from 1996. Melbourne house prices have grown by 4.32%.
And you think about the drivers behind that. It's absolutely comes back to
what's ludicrous about that, though. I don't understand what's ludicrous about sub 4.5% real growth per annum.
Well, and here it is. It basically says what's happened is over that time, wages have grown in line with inflation. I'm guessing inflation would have averaged about 3 and a bit. And
yeah,
so,
I don't have that in front of me. I've only got the results.
It's something like that. And so let's assume inflation's grown at 3 and a bit. We go, okay, that's 3 out of call it the 6. The other 6, how many years was it? It was back to 1990.
So 1996.
1996. It's 25 years ago.
25 years.
25 years. My maths are going to fail me here. 3% a year for 25 years, I think pretty much doubles your prices. And over that period, interest rates have halved. So the amount the bank will give you has doubled. Housing prices have doubled. So it's basically this same formula. It's how much will the banks give you? And how much they'll give you is depending on interest rates and average weekly earnings. And I'm like, we've just done it on the back of the envelope, but I've run the numbers in real time. And it's like there's leads and lags, but it absolutely comes out that way. And it doesn't only come out that way here. It comes about everywhere in the world where there is a limited supply of land. So you go to Texas, doesn't really work. Dallas is a huge sprawling city. There's not so much clear city centers. If they want more, they just build some more stuff. New York, London, really different story. Absolutely applies there. So if it's tight for land, then you get this thing. Because the idea is this, classical economics, it's supply and demand, and the price keeps going up until something stops it. Now, because accommodation is a basic human need, you don't say, prices are up, we don't need to live anywhere this week. It's you will chase it until you stop. And where is the stop? It's what the bank will give you.
Yep.
And like it just it makes sense every which way. And the other thing it's kind of useful to say, well, if we're here talking about this one, where will this go in future? And I think it goes, and as I said, there are leads and lags, so there may be some more room to move on the upside. But when housing prices have caught up where interest rates are now, and interest rates are based on cash rates, and cash rates are at 0, well, that's the end of it. From here on in, I think interest rates go back to about 2. And given bank margins and so on, that over a period of time, it knocks probably 20% off housing prices, but it'll take a while. The prices will be sticky. They're stickier on the way down. So I think you've got 20% off housing prices eventually, and wages are picking up kind of 2% a year.
But so you're talking about 20% off prices. Like you could have it. So many people think about this in a binary outcome. That is, either prices are rising or prices are falling.
Yeah.
But what could also absolutely happen is nothing happens for prices, and in real terms, your price may have declined by 20%. I think we should clarify that.
I think that's absolutely right, because it's if you said from this point today and said 10 years' time where we're going to be, I think 10 years' time we can be reasonably confident that interest rates have picked up a little bit, but not much. That will have had a negative impact, but wages will have gone up. And from here to there, it's kind of flat.
Yeah. Yeah.
And whether it's actually flat or down then up a bit or up a bit more then down, like who knows? But I'm pretty sure that if you buy a house sometime in the next, probably not, maybe not today because there's still some fuel in the system, but if you bought a house towards the end of this year, I reckon by the end of 2032, you'll look at it and go, it's about the same. So this is a one-off boom that's been totally driven by APRA's change to the way banks allocate money to housing. And I think we've reached the end of it because interest rates aren't going much lower than zero. And so there's no more room to move on that one. We have played,
and people's capacity is going to diminish from here, unless, of course, there is significant and sustainable wage growth and people's incomes rise.
Absolutely.
In the absence of that, look, I don't disagree with you. I don't know if this is a one-off lifetime generational boom or sort of pop. There might be others that happen, but I do agree with you that the likelihood of prices continuing to rise at the pace that they've been rising, it's really hard to see. But then again, no one saw anything that's unfolded today. So we could be
that's not fair. That's
absolutely
not fair.
Completely wrong, right?
We talked about this, I think, last year and said this is going to happen. As soon we had this conversation, as soon as
I'll have to look it up.
As soon as APRA relaxed those lending standards, said this is going to go nuts.
Yeah.
And it's how far it was going to go, who knows? You've seen them. I do my predictions once a year at the start of the year, which is they're somewhat tongue in cheek. But I said residential property prices were going to go up substantially this year. It was like it was just the way this thing works.
Yeah. What's really interesting, I read a headline over the weekend. I was at the bakery, waiting to get to the front of the queue, picked up the paper. Property prices poised to rise 15 to 20% in 2022. And it was off the back of school zoning changes coming into effect in certain areas. And that's a big thing. It's something that I've been exposed to and family been, but most people are exposed to this. It's ludicrous the premium that is paid above, the house that's in the zone or not the zone. So again, we always talk about this.
You can get pockets of activity.
We're going to have pockets, right? We're going to have pockets and markets within the markets.
And it's no different from the share market where you can say, the share market hasn't gone anywhere for the last 5 years. Oh, but what about this company? It's gone up 5,000%.
If you're talking about the share market, you've got a handful of companies that are basically pushing up the broader market. And you've got, I think it's something like in the S&P 500, I think the top 10 companies account for 30 or 40% of the price rise. I mean, that's the reflection of their market capitalization. So it makes total sense. But there are more stocks lagging the index than there are beating the index. And so what happens naturally is the number of stocks in the universe that are outperforming the index diminishes and diminishes and diminishes. And you've got, a very few handful of companies pushing the broader market to where it is today. On that note, with where prices are now, you've got, just having a look at some numbers here, you've got, this is US market again.
Yep.
US stock market free cash flow sitting at absolute record highs at about 2.4 billion in aggregate. You've got US stock market net profit sitting at about 1.5 billion, again, another record. And then you've got record net profit margins as an aggregate in the stock. So you've got the stock market at record highs. You've got interest rates at record lows. You've got bond yields at record lows, government bonds. What are they paying? I don't know, 70 basis points, 80 basis points. With
they're up to 100, they're up to 1.2, 1.3. Actually, bond rates are higher in the States than Australia at the moment, which is kind of interesting.
Yeah, that's right. I was more talking about Australian. Right. I don't know what
here
it's at the moment.
It's about 1.2 for 10 years.
Cool. So you're at 1.2, right, for the 10 year. And so we're in this situation where we've hit rock bottom. We talk about inflation. We talk about interest rates and whatnot. And we've just spent a good 30 minutes, 40 minutes on how this impacts other asset classes. Where do investors go from here?
Well, the US one's a really interesting one. A bunch of things. Firstly, and I think I saw some of your writings have indicated this. One of the things we should not be terrified is record high prices, because that's what stocks are meant to do. The whole idea of the stock market
that's right.
is they grow. We should be surprised when stock prices aren't at record highs. And we because we expect earnings to go to record highs, because companies are meant to grow. And so that's kind of all good. The question really is how fast they can grow. And those handful of companies you mentioned have grown incredibly fast. One of the interesting things thoughts I have around these is Google, Facebook, I think Alibaba, the big ones, Amazon to a much smaller extent, are basically advertising companies.
Sure.
I think Facebook get 95% of the revenue from advertising. Google's much the same. They are trying to get into other businesses, but right now they're advertising companies. Now,
aren't we all advertising companies, Tim? Or
no,
my business.
No.
We're all in the advertising game.
But we're on the spending side, not on the receiving side. They get paid when other people advertise. And that's a crucial distinction. But they've gone from having a very low share of the world's advertising market. Now, those companies now control about 50 to 6% of all advertising revenues in the world. And I've tracked them. Advertising revenues grow at about GDP less 1. So their phenomenal growth has been they're gaining market share. Now, they've already got 50% share. They can't do it again. Not through that business model. So the big question for you, Googles and all of those ones, is to say, and Facebook, is what is their next trick? Because their current trick is going to go from this hugely high growth model to a very low growth model, because they've sucked it all and they've got it all. And they're investing in lots of other different things. Maybe they get there, maybe they don't. But they've got a much more challenging future ahead of them from here than what you would gather from looking at the past.
Yeah, but haven't we been saying that for the last 10 years? You look at every time you look at Apple's next launch, everyone's queuing up going, well, what's the next trick by the trick pony? Every single time they've delivered. Amazon are now making a ton of money coming in from their cloud business. You've got Apple making even more money on, it's gone from phones to tablets to e-pieces to now watches. It's a huge contributor to the bottom line. When are we going to stop doubting these companies that they're not going to be able to deliver on the next thing?
Okay. Ultimately, for them to grow at the same rate they have in the past, they will control more than 100% of GDP. I'm pretty confident that's not going to happen. That they are very significant sized companies, and it's easy 100%. To grow. Easy to go small to very large. When you get very large, it's much, much harder. And you refer to record margins. Well, record margins is when you've got a monopolistic position and you can charge pretty much whatever you like. People are coming after them. Now, their current approach has been really successful. Is someone comes up and let us buy them. And so but ultimately, most of these people coming out are still in the same business, which is advertising.
But could this be the case, like we talked about residential property, where it doesn't necessarily need to be a binary outcome? Like they could still remain at the top. Like if you look back especially in the US market, you've got the likes of General Electric, AT&T, IBM. Like a lot of these big companies, they're not around anymore. Well, they're around, but they're no longer sitting at the top. We all know that.
Yes,
but they do become the largest, and they do and can and have stayed at the top of their game for a very long period of time. Microsoft jumped in, it fell out, it's back in again. And so could it be at all possible that the Googles and the Facebooks and the Amazons remain on top, but to your point, can't continue to grow at that pace, and they remain on top for a period of time? And then what happens? You've got new emerging companies coming out and they start to take market share. Yeah. Is that the kind of base case scenario?
Absolutely. And I'm not saying these people are about to go away. It's just that if you've got 50% market share, well, let me put it this way. When you go from 25% to 50% market share, that's 100% growth. To go to 50 to 100%, there's 100, and then there's no more growth ever again. And so it's like they've had the big yards. They have now got to a size where they've got to find something else. Now, they have proven to be absolutely brilliant at getting advertising revenue, but not much else. And the question is, it's not as if no one else is trying. And you kind of think, actually, no, there are startups every day coming up doing, we're going to get the next one of these. And there's a huge amount of venture capital out there backing these people. And so the question is, are all these other people useless?
Well, the problem is the big boys have got so much cash on their balance sheet, they just acquire.
They keep buying. Yeah. But it's that they need to find ways to get into other markets. And even then there's a problem in that, I track sales on the S&P 500. Sales on the S&P 500, not surprisingly, grow at about the same rate as GDP. So that says the sales on the S&P 500 in the long term can only grow at, call it real GDP growth is 2, and plus inflation of 1 and 2, it's 3% a year. Actually, they grow a little slower than that. So in order to grow faster than 3% a year, this is all this S&P 500, including the dominant companies. In order to grow faster than that, their margins have got to go up. Margins are at record high. We know there's a business cycle. During the business cycle, when things are booming, margins are high and they go down. So you're kind of making the bet to say, if you want these companies to grow much faster than 3% in aggregate, then margins have got to go up even further. And it comes back to all this stuff about equality and monopolies and all of that, which gradually governments are starting to turn their minds to. It's you saw recently they want to actually introduce universal or minimum rate of tax on American companies around the world. That's kind of the start of it. That comes straight out of margins.
It's interesting you talk about margins. Just looking at a chart here that looks at net profit, US stock market net profit margin, and naturally once they hit record numbers, they don't last there very long. A few quarters, couple of years, and then you start dropping off from there. And it drops off from there because a whole bunch of other things are happening as well. Tim, I'm gonna wrap up. Brilliant chatting with you. I think we're gonna have to keep our eyes cocked on whether or not what goes on in the property market, and we'll see who was right on that one. But my money's on the fact that not much is going to happen. We're going to track sideways. I reckon we'll get real prices going backwards, and we haven't been here. I mean, we've been talking about and saying that for the last however many years now. I don't know how much more longer we can say it, but the bond market certainly is telling us that we're gonna be here for a bloody long time. But time will tell. Thanks, Tim.
Yes. Okay. Thanks, Robert.